Okay. So the statement of cash flows we are familiar with. We've been talking about it all semester. And I think we've even made some simple statements of cash flow at some point, but, or maybe not, maybe I'm imagining that. But in this chapter, we're going to do a deep dive into how to create the statement of cash flows. I've probably told you, I think this is the hardest chapter, which is why it's good that we have a little bit of extra time on this one and we don't have to rush through it. So we'll learn, well, you already know why we need a statement of cash flows, but we'll review that. We will learn about the 3 different sections of the statement of cash flows. And actually, since you're going to be analyzing statements of cash flows in your assignments that you're going to be working on, it's a good thing that we are talking about this and you have a better understanding of these 3 different sections, why they're each important, and how they're created. So the operating section of the statement of cash flows can be created 2 different ways. There's the indirect method, which we will learn, and that's what we'll spend more time on. But there's also the direct method. We will spend a little bit of time on that one as well. They're both complex, and in practice, it's easier for accountants to use the indirect method. But while you're learning it, it seems really complicated. So that's why we'll spend more time on that one. We'll also learn some new ratios, the free cash flow ratio, and a couple of variations on that. So that is what we'll learn this week. So let's review, what is the purpose of the statement of cash flows? Why do we need a statement just about cash flows if we already know the profit or loss from the income statement? What's different about the income statement and the statement of cash flows? Does the income statement tell you how much cash you have? And why not? It tells you how much revenue you earn and how much expense you had. So why does it not tell you how much cash you have? Remember that whole accrual basis of accounting thing, where you can count revenue even though you haven't been paid. You can count expenses even though you haven't paid for them. And that's why we need the statement of cash flows that tells us how much actual cash came in and went out, which is different from how much we sold and our expenses. If we use the cash basis of accounting, which only small companies and nonprofits can do that, but if we did use the cash basis, then our income statement would be the same, or not the same, but it would tell us how much cash we had. But since most companies use the accrual basis, they need both. They need the income statement to know how profitable they were. They need the statement of cash flows to figure out how much cash they have. Okay. So I think I covered everything on this slide. So as I mentioned, there is an indirect method for the operating section, and there is a direct method. Now, operating cash flows are the majority of the cash flows for most companies, because it includes money you made from selling your product and money you spent running the company and making your product. So for most companies, that's where most of the cash is coming in and going out. The other areas, the investing cash flow and the financing cash flow, tend to be smaller. And it's this operating section that has 2 methods, the indirect and the direct. The reason the indirect method is called indirect is because you start with net income. And net income comes from which financial statement? Where do we find net income? I know it's the end of the semester, but hang in there, folks. You got a week left, right? Week and a half. So where do we get net income? Income statement. Okay. You know that. Now I just told you, reminded you, that the income statement does not tell us our cash flow. It tells us our profits or losses, right? So why do we then start with net income to figure out our cash flow from operations? Well, that's why it's called the indirect method, because we take our net income, our profit, and then we make a bunch of adjustments to it so that we can figure out what our cash flow from operations is. So we're not really counting cash flow. It's not a direct way to figure out our cash. It's indirect because we're starting with something that has nothing to do with cash and then making adjustments. We'll get into those adjustments a little bit later. However, the direct method, you actually count how much cash did we receive from our customers and how much cash did we pay for our expenses. So that's why that's the direct method. We'll get to that one later. So as I mentioned, the operating section is where the majority of the cash flow is. It relates to inventory, any cost to make your inventory, acquire your inventory, pay your employees, any money that came in from selling your product, all of that relates to operations. Then we have a section, investing, cash flow related to investing. So you could think of this as twofold. There is investing in other companies, like buying stocks and bonds. Companies can do that, right? They could invest in other companies. But it's also investing in your own company. So if you buy equipment, you buy land or any other long-term assets, you're investing in your own company. So the investing section includes both investments in other companies and investments in your own. And then the third section is cash flow from financing. This would be anything related to debt, like loans or issuing bonds, and equity, issuing stock. That all falls under financing. Okay? Now, whether you use the indirect method or the direct method for the operating section, you should get the same answer for your net cash flow for operating. So it shouldn't matter which approach you use, it's just two different ways to get to the same number. If you do it both ways and you get to a different number, with one way than with the other way, then there's something wrong. With the investing and financing sections, there's only one way to do each of those. So that makes it simple. Well, simpler. The operating section is the more complicated area. Okay, so let's go through how do you calculate cash flow from operations using the indirect methods. There's an accounting stuff video on that accounting stuff page just about this. Again, we start with net income from the income statement, right? And then we have to make our adjustments. Things like depreciation, amortization, and depletion. Remember those from our long-term assets chapter? These are expenses, right? This is how you take the expenses on your long-term assets over a period of time. So let's take depreciation for an example. You buy a building, and every year you can take depreciation on that building. That's an expense, right? You can't claim the whole expense of the building at one time, but you can take depreciation over time. So every year you're taking that depreciation expense. That means it's going to show up on your income statement as an expense. But there's no cash flow associated with that expense. It's just an accounting calculation, right? You're just saying this year we had this much depreciation expense on the building, but it has nothing to do with your cash flow. So that's an example of an expense that did not have anything to do with cash. Well, since we're trying to figure out our cash flow, and we're starting with our net income, which is revenue minus expenses, we need to add those non-cash expenses back in to figure out what our cash flow is. In other words, we need to get rid of those expenses. So we start with net income, add back any non-cash expenses like depreciation. Then let's say we had sold some assets and we either had a gain or a loss from selling these assets. Okay. The problem is that's not considered an operating activity, that's an investing activity. Your long-term assets, as I mentioned before, they're an investment in your own company. So when you sell them, whether you've made a gain or you had a loss, we need to get that out of our operating cash flow calculation because it's an investing activity. So we need to reverse any gains or losses from the sale of assets. If we had a gain, we have to subtract that amount. If we had a loss, we need to add that amount. And this is one of the adjustments that'll help us figure out our net cash flow from operations using this indirect method. Then we have to remove any accrued revenue or expenses. Any change to like accounts receivable, accounts payable, we need to do the opposite. You might be noticing there's a lot of opposites going on here, right? We're reversing our depreciation, we're reversing any gains and losses, and we're reversing any changes in our assets, in our short-term assets. However, changes in short-term liabilities move in the same direction as cash. So think about it this way. If our accounts payable went down, we paid down some debts to our suppliers. How did we do that? We paid cash. So with short-term liabilities, whatever they change, cash goes the same way. Yeah, I was saying this is kind of complicated. Okay, so again, with the indirect method or the operating section of the statement of cash flows, start with your net income, reverse any non-cash expenses, reverse any gains or losses, reverse any change in your current assets, and then also any changes in current liabilities affect cash in the same direction. If those liabilities went up, cash goes up. If those liabilities went down, cash goes down. That is how you calculate your net cash flow using the indirect method. We'll go through and we'll practice this, right? It'll make more sense when we see examples. Are there any questions so far? Right. Then we have the other two sections, investing activities and financing activities. Those get a little tricky on their own, but they're more straightforward, I think, than the operating section. So we'll get to those later. So once you've done that, once you've figured out the cash flow in each of these three sections, operating, investing, and financing, you can add up all three of them, and that's your total cash flow. So let's say You add them all up and you get $100,000. What that means is from the beginning of the period until the end of the period, your cash went up by $100,000. And if you look in the cash account, from the beginning of the year to the end of the year, you should see that it went up $100,000. So your cash flow statement should conform with your actual cash account in the ledger, also on the balance sheet. There are some transactions that do not involve cash. We'll see some examples of those. Like, let's say we bought a building, but we financed it 100%. We just took out a loan to buy the building. Well, then there was no cash in that transaction. We took out a loan, we got a building. No cash involved. We would list that still on our statement of cash flows, but it would be in a separate section. So it's not actually part of our calculation because, again, there was no cash involved. So we just list it kind of like, if you remember with contingent liabilities, we just list them as a note in some cases. And that's what we would do here. Just make a note on your statement of cash flows. So to do this indirect method, we need information from the income statement, right? We need the net income. And we also need to know the balance in the cash account, so we can get that on the balance sheet. So here we see the balance sheet. Under assets, the very first thing is our cash. And if we look at 2 years, end of 2017 and end of 2018, we can see cash changed by this much, 23,200. So our statement of cash flows should show for that year, we had $23,200 of net cash flow. It should match the balance sheet. On the income statement, again, we start with net income, right? To create our operating cash flow. Okay, so here's some extra information we're going to need to create our first statement of cash flows here. Our company sold some land and it cost $10,000, but we sold it for $14,800. With that information, tell me, did we have a gain on the sale of that asset or a loss? We bought it for $10,000, we sold it for $14,800. Gain or loss? It's a gain, right? We sold it for more than the book value. And remember, land doesn't depreciate, so the book value is whatever we paid for it. Okay, and remember that with gains, that's one of the adjustments. We have to reverse that gain to get it out of the operating section because it belongs, this $14,800 of cash we received from selling the land, it belongs in the investing section, not the operating section. Then we bought some other land for $20,000 using a note payable. That's one of those non-cash transactions, right? So it does not factor in to our calculations on the statement of cash flows, but we will list it as a note. Okay, we also bought some plant assets, so maybe some equipment for our factory or something like that. $40,000, we paid cash. Which section of the statement of cash flows would that show up on? Operating, investing, or finance? We bought some equipment. Where does that go? Remember how I said, if you buy long-term assets, it's like you're investing in your own company, right? So it goes under the investing section. The company then paid a dividend to shareholders. Which section would that go under? Operating, investing, or finance?
financing?
Yes, financing, that's right. When we sell stock, the money that we get is income in cash, and that would be under the financing section. But when we pay dividends to those investors, that also is in the financing section. It's outgoing cash, but it's still related to financing. So here, when we issue stock, that would be 45,000 coming in the financing section, and that dividend would be $440 going out. Okay. So now that we have that information, let's go through it. The following slides take us step by step, but I think it's kind of easier if we can look at the whole thing at one time. That doesn't quite work. Let's just make it a little. Here we go. So let's just go through this statement of cash flows and see what's going on here. That's fine. Now we can see that this statement of cash flows was created using the indirect method. Well, we can see that because it actually says statement of cash flows, indirect method. But even if it didn't say that, it starts with net income, which tells us this is using the indirect method. Okay. Now, this tells us what period it's for. It's for an entire year, ending December 31st, 2018. Okay. So we start with that net income. Then we have to make all these adjustments here. Let's see what those adjustments are. There was some depreciation. And remember, there's no cash involved with depreciation, right? That's an expense that's part of the net income, but there was no cash. So we need to get rid of it. So we're going to add that $14,400 to this number to increase our cash flow calculation. But we're going to use all these numbers together at one time. So here is the gain. Remember, we sold plant assets, and we had sold them for $14,800, but we had originally paid $10,000, right? So that was a gain of $4,800. But we have to reverse that. We have to get it out of this operating section, and we'll see the entire $14,800 we got when we sold those assets. All of that cash goes in the investing section. But the gain, we need to get out of this section. So we reverse it. In other words, because it's in parentheses, that means it's negative, cash will go down. Okay, remember I said with changes in our short-term assets, like accounts receivable, cash does the opposite. Accounts receivable is going down, cash goes up. Prepaid insurance, which is also an asset, is going up, cash goes down. Inventory is going up, cash goes down. Then we get to our short-term liabilities. Remember that those move in the same direction as cash. So here we have accounts payable going down, cash goes down, salaries payable going up, cash goes up. So this takes a little getting used to, but we'll be going through this a couple more times between now and the end of next week. But if you take all of these adjustments and add them up, you get a total of $9,500. We add that to our net income. That is how we get to our net cash flow from operating activities. Again, if we use the direct method, which we'll get to next week, we would come up to the same answer. We would just get there a different way. Any questions here on this indirect method, the operating section? Okay, let's look at the investing section. So again, we got money from selling land. That was incoming cash, so that's a positive number. And then we bought some equipment. We paid $40,000 cash. That's also considered an investment in our company, but that's cash going out. And so we combine these together and we have negative $25,200. So there was $25,200 more going out related to investing activities than there was coming in. Then we can move on to the financing section here. Okay. Yep. All right, let's see what's happening here. It says payment of notes payable. So we paid down some notes payable that we had, $10,000. That was, we'll go back, let's see. I think that was from the land that we sold. Let me try to go back to a previous page and see that. Yeah, I think that $10,000 we paid for a note payable was from this land that we sold. We probably still owed the original $10,000 on it. I guess we had never paid the mortgage. Or maybe we'd only paid the interest. And so when we sold it, you have to pay off the mortgage. If you sell property that is collateral for a loan, you then have to pay off the loan. So that's probably where that $10,000 is coming from. We also issued stock, which brought in $45,000. You see that's a positive number, and then we paid out those dividends. So all three of those, remember anything related to debt or equity goes in the financing section. All of that together is $34,560 cash flow. Then we could take our operating plus investing plus financing cash flows to get our total cash flow. And that total cash flow, if you add it to your beginning cash balance, should equal your ending cash balance. Again, if it doesn't, there's a mistake somewhere. So this is why if you look at your balance sheet or you look at your cash account and you see what was our balance at the end of last year versus what was our balance at the end of this year, or the most recent year, which would be these two numbers, the difference should be your cash flow for that year. And then any non-cash activities like buying land, using a note payable would be listed here. But notice that this $20,000 was not part of the calculations because there was no cash involved. So it's just listed there for reference for investors. Okay. Clear as mud. Any questions on this statement of cash flow calculation? All right, let's see. Okay, yeah, so these next few slides again are the same things we just walked through, so I'm going to skip some of this. But just as a reminder, to do the operating section, you start with your net income, you add back any non-cash transactions like depreciation, you reverse any gains or losses on the sale of assets. If there's a change in your assets, in your short-term assets, cash does the opposite, right? So we see these assets are going up, cash goes down. We see here's an asset going down, cash goes up. Changes in short-term liabilities, remember, cash goes in the same direction. So the salaries payable went up, cash goes up. Accounts payable goes down, cash goes down. And we already walked through that, so I don't need to go through it again. So let's test our knowledge here. Let's figure out the cash flow from operating activities for this company. If we're going to use the indirect method, what do we start with? It's the first piece of information we need. Net income. Thank you. Exactly, and it's right here. What would we do next? What was the next step? Exactly. Add back non-cash expenses like depreciation. So we would take that 19,900 and we would add $12,000. Then we would reverse any gains or losses. I don't see any gains or losses here. Then accounts receivable went down, right? Accounts receivable is an asset, current asset that went down. What do we do with cash? Increase or decrease? Current asset goes down, cash increases, correct. Then merchandise inventory is another short-term asset, it increases. So what do we do with cash? Decrease, right? Just remember, everything, all of your calculations, you're doing the opposite, right? You're reversing your depreciation, you're reversing gains and losses, you're reversing any changes in assets. The exception to that is with the short-term liabilities, like accounts payable. When a short-term liability goes down, cash goes down. The short-term liability goes up, cash goes up. So if you just keep that in mind, it'll make this a lot easier. Okay, we're up to exercise 6. I also did not open up my exercise set. I should have done that. So let's go ahead and work on that. So if you can, go ahead. Okay, explain why your cash balance did not increase much from the beginning of 2018 to the end of 2018. So this company earned net income of $88,000. But if you look at their cash, it only went up about $50,000. So if you're the accountant and the CEO comes to you and says, hey, we made $88,000. Why did our cash only go up by 50,000? Looking at the information here, what would you tell them so they would understand why your cash did not go up 88,000?
Yeah, bills to pay.
Bills to pay, okay? Exactly. We see accounts payable went down. How do accounts payable go down? If you pay them, right? We must have paid down some money that we owed to some suppliers. Prepaid costs for insurance and rent have also gone down. That might have just been from using it though. That might not have been cash flow related. So definitely accounts payable has a big impact. What about the change in accounts receivable? Would that have any impact on our cash flow? Accounts receivable went up by what, almost $20,000? What does that tell us? People owe us money. So while we've been paying down our suppliers, we haven't been keeping up with how much money our customers owe us. We haven't been collecting fast enough. You know, maybe it's okay because if we're selling a lot of product and we feel like we'll collect the money later, maybe that's okay. But in the meantime, that's almost $20,000 that's sitting out there uncollected compared to a year ago. and we paid down about $20,000 of debt. So yeah, it makes sense that our cash flow, did not go up 88,000. Okay, questions or comments? Right. Okay, I already mentioned to you that in the investing section and the financing section, there's only one way to create each of those. So that indirect method that we learned only relates to the operating section. So what else does this say? Okay, so for the investing section, we would look at the long-term assets in the balance sheet to see, did our land, our equipment, any other long-term assets go up? Did it go down? That would give us some insight into what happened with our investing cash flow. So here's an example. So this is looking at a balance sheet, looking at the assets section, which always starts with the current assets, but then you get into your long-term assets. So in this case, we've got land and plant assets, probably factory equipment or something like that. And we can see how they changed. From 2017 to 2018, our land went up by $10,000. So that was a $10,000 increase. Our plant assets went up from 190,000 to 230,000. That was a $40,000 increase. Now, does that necessarily mean we used cash to acquire those extra assets? Not necessarily, right? So this is helpful, but it doesn't tell us the whole picture. So when we look here, it says we sold land that cost $10,000. We sold it for $14,800. Okay, but remember, our land went up by $10,000. This is saying we sold $10,000 worth of land, but it went up $10,000. Well, that's because we also bought $20,000 worth of land. So we have $20,000 more that we bought in land and $10,000 that we sold. So the net impact is a $10,000 increase. The land that we sold generated $14,800 in cash. Again, that's an investing activity. So that will go under the investing section. The land that we bought, we didn't use cash for. So that's a non-cash activity that gets listed at the bottom of the statement of cash flows. And then those plant assets of $40,000, we paid cash for those. So that's going to go on that investing section as well. So we see the money we got from selling the land. We see the $40,000 we paid for new equipment. And that's the net impact of those investing activities on cash. And then the non-cash activity, again, is listed separately. So the investing section is usually not that hard. What gets a little bit tricky is just remembering what goes in the investing section. Because again, it's both investments in other companies and investment in our own company. But here's an exception. If we earn interest on an investment, that interest that we earn goes under the operating section. Seems weird. We think it would just go under investing, but the interest we earn from an investment goes under the operating section. So that's one thing you just kind of have to remember. Okay. Here's another example. Let's see. Our company decided to sell land and buy a building. So we bought a building for $85,000 to be the storefront for our bakery. Obviously, it's not around here, right? You're not gonna buy a building for $85,000, maybe a shed, but not an entire storefront. We collected interest on investment assets, $2,250. And we made a gain on the sale of the land, $25,200. The land originally cost us $22,000. Okay. What would be our investing cash flow based on these transactions? Assuming we paid cash for the new building, that would be outgoing cash flow, 85,000, related to investing activities, right? What about collected interest on investment assets? Would that go in our investing section? Interest collected from our investing assets. Remember, that goes under operating. You might think it would go under investing, the interest goes under operating. Okay, and here's another question for you. When we sold the land, we had a gain of $25,200, and the land originally cost us $22,000. How much did we sell the land for? You can tell.
$105,200. Wait, no, 100.
That would not be
10.
correct, because that was the gain, right? That was the gain. How do you calculate the gain? The gain is the sales price minus the book value. And for land, the book value is just whatever you paid for it. In other words, we sold the land for the combination of these two, $47,200. That's how much cash we got from selling the land. The gain is just the sales price minus the original cost. We have to add that gain to the original cost to figure out the sales price. Okay, keep that in mind. Any questions? All right. See, I think we'll probably just cover a few more slides. Let me see where we're at, and then we'll do the discussion. Yeah, just a few more slides here. Because we're almost halfway through this chapter. Okay, the financing section. Again, there's no direct or indirect method. There's only one way to do the financing section. And the financing section is everything related to loans, issuing bonds, issuing stock, and anything related, including paying dividends, paying interest on the loans, all of that would go under the financing section. We will look at the liability and stockholders' equity sections of the balance sheet to help us figure out what financing transactions occurred. So here we go for an example, notes payable. We know those are a liability, right? Those are a type of loan. So that's going to be relevant for our financing cash flow. And then down here, we have changes to common stock and changes to retained earnings. So on the balance sheet, we can get that useful information. But again, we don't necessarily know how much cash was involved in each transaction. So let's take a look here. It says we bought some land for $20,000 in exchange for a note. We saw that already, right? We saw that in the investing section. because the land we bought was an investment. Why is it also showing up here when we're talking about financing? Because we financed it with a note. So that relates to financing, but again, there was no cash. So we don't actually include that in our calculation. We paid out dividends. Again, that's part of financing. And let's see, we issued common stock in exchange for cash. Okay, so we can see common stock went up from last year to this year by $45,000 because we sold some stock. So that's how much cash we got from that transaction. We can see our retained earnings went up. If you take the increase in retained earnings, it's equal to the increase in net income minus any dividends that we paid out. Okay, so again, we had the money that came in from selling stock. Remember, we took out a new note for $20,000 to buy some land. But our notes payable only went up by $10,000. That's because we also paid down an old note of $10,000, right? So that's a financing activity. The new note had no cash involved, right? We weren't borrowing money. We were taking out a loan that we used to finance buying the land. But the old note, there was cash involved because we paid $10,000 to pay it off. So that's $10,000 going out the door. So we have $45,000 coming in from cash, $10,000 going out to pay down the note, and $440 going out for dividends. And then again, our non-cash transaction. So that gives us our net change from financing activities. And I think, yeah, is this the same company? Yeah, okay, this is the same company, so we'll just wrap it up with this. So if we take this company's net income, add the adjustments, that gives us the net cash flow from operating activities. Subtract the negative cash flow from investing, add the positive cash flow from financing, add that to our beginning cash. No, I'm sorry. We add those three together to get our total change in cash, add that to our beginning cash, and it equals our ending cash, which we can verify with the balance sheet. And then we also list the non-cash transaction. So now we have a completed statement of cash flows created using the indirect method for the operating section. All right, any questions on this chapter? Okay, I think that's the hardest part of the hardest chapter. And as you work on it next week, I think it'll start to make more sense to you. Let me stop recording here. We will move on and do our discussion number 4.